Hi everyone, welcome to week 3. I hope you're having an enjoyable and knowledgeable journey to this point in time. Today we're going to talk a little bit about investors. That's a tough subject. Investors are not easy to do business with. We talk about entrepreneurs being risk averse and therefore sometimes afraid to make decisions. Well, investors are very risk averse. They don't like to invest unless they're absolutely certain in their mind that something's going to work. So let's ask ourselves and answer a few questions and answers relative to what investors think or look for. The first question would be, why would investors use a decision tree to evaluate business ideas? Well, investors have to consider numerous new business ideas virtually every day. They need to be able to quickly screen out the least promising ideas to give themselves focus and truly promising ideas. A follow-up question you might ask would be, but doesn't that method of screening result in over-rejection? Well, yeah, actually it does. Investors are willing to over-reject because the pain of a foregone investment that would have turned out well is less than the pain of an investment made that turned out badly. You might ask additionally, so then why would investors use key elements for success to evaluate business models? Well, most startup investments fail. Over 90% of all companies that start up fail in the first 5 years. So, assuming most investors evaluate business ideas based on these key elements for success, we can assume that all failing investments had the elements required to succeed. This suggests that failure rates of businesses without one or more key element for success would fail at even higher rates than current VC investments. And don't forget, VC is short for venture capital. A second follow-up question you might ask is, but isn't execution really the key success factor? In other words, won't winning companies be the ones who execute better than the competition? What really determines whether a business will succeed or fail in the end is really execution. But companies first need to raise money before their business can start and before good execution can actually take place. So they really won't be able to successfully raise money by saying, well, we're going to be successful because we can execute better than all of our competition. This may seem a bit paradoxical because we just said that execution determines whether the company will succeed or fail. What we really need to do to succeed is we're going to have to execute better, but again, we can't raise money on the basis of claiming we're going to execute better. Why? Well, we can kind of take a look at this apparent paradoxy by looking at it from the investor's perspective. How many entrepreneurs do you know or would you think would say, when asked whether or not they would execute better than the competition, would answer yes? Well, the answer clearly is 100%. But actually, in real life, the percentage of those that will out-execute everyone else is unbelievably small, extremely small. So claims that this company will out-execute the competition is really useless to an investor when they evaluate potential investors. Investors need to evaluate the business based on factors that are really tangible, something they can see and feel right now, something that they can get a hold of and go, I think that will work, I believe in it. One of those is market traction, but sometimes the company doesn't have market traction. They'll look at other elements then, the investors will, which includes the business plan, because the business plan incorporates tangible elements. For example, is the product or business model creative, innovative? Is the company solving some kind of problem, even a painful problem for customers? These are all potential success factors that can be evaluated in the present. So how do we do these business plans? How should I write an effective executive summary, which is the first element of a business plan? The executive summary should be a really short version of everything else, that is all the other sections of the business plan. And don't forget, the business plan is your final project for this course, so all of this is relevant to what you're going to be doing in preparing for your final project. The summary can be standalone, and it should be the first part of every business plan. In a business plan, the executive summary plays the role of a book, a jacket, or a book cover. When you're trying to decide which book you want to buy, how do you really choose that book? We're told that you cannot judge a book by its cover, but in fact, almost everybody buys a book based on the cover. The first thing you notice about the book is its cover. Is it attractive? Is it interesting? Is it professional? Is it colorful? Is it concise? Hopefully it is compelling enough to make you pick it up and look through it to see if you really want to buy it. And what happens if you don't find it interesting? Well, it's over, right? The book goes back in the bin and you move on. This is the exact same situation with regards to an executive summary and the role that it has in your business plan. If the investor thinks the executive summary is not interesting, they're just not going to continue to read it. And they're going to lose an interest in your plan. So it's back to the bin and on to the next plan. So the executive summary has to really, really grab their attention. You don't write an executive summary like an essay, where you're constantly building up to some overall global conclusion. Nobody will stay with it for that long. Write it like a newspaper story. If you notice in newspaper stories, the most important information always comes at the beginning. In a newspaper article, the first paragraph always contains the pertinent information, the key elements, those things that attract your attention and then convince you to read the entire story or at least most of it. The rest becomes less and less important. We use the same type of structure for the executive summary and later for the balance of the business plan. That is, everything in the plan should be focused and on point. If you start off strong and investors don't continue to read the whole thing, they may still get the important points that keep their attention. And the executive summary, therefore, does come first.